when long-term thinking created short-term chaos. The plan was built for decades. The failure unfolded in days. And the gap between those two timelines is where the story begins. For years, investors were encouraged to think long-term, ignore noise, ride out volatility, trust the horizon. It was sensible advice, supported by history and rewarded by patience. Long-term thinking became more than a strategy. It became a virtue, the mark of discipline in an increasingly reactive world. This mindset mattered because markets were changing. Short-term trading accelerated. Information cycles compressed. Prices moved faster than fundamentals. In response, long-term capital positioned itself as a stabilizing force. Pension funds, endowments, institutions with obligations measured in decades, not quarters. Their presence was meant to smooth the system. At first, it worked. Long-term investors provided steady demand. They absorbed short-term shocks. They dampened volatility by committing capital without regard for daily fluctuations. Markets grew calmer. Drawdowns felt manageable. The narrative wrote itself. Patience was winning, but embedded within the success was a quiet shift. Long-term thinking began to influence structure, not just behavior. Assets were chosen not for flexibility, but for durability. Liquidity was treated as secondary. After all, these positions were not meant to be traded. They were meant to be held. Over time, portfolios grew heavier. Exposure increased. Commitments became harder to unwind. Long horizons justified tighter structures. Lockups lengthened. Rebalancing slowed. The system assumed that time itself would solve most problems. What nobody fully confronted was how these long-term positions would behave if short-term conditions changed rapidly. Not fundamentals, not value, just timing, just liquidity, just the pace at which prices needed to adjust. The contradiction was subtle but dangerous. Long-term investors reduced short-term volatility by holding firm, but by doing so, they also reduced the system's ability to adapt quickly. Stability was achieved by sacrificing responsiveness. As long as markets moved gradually, this trade-off remained invisible. But markets do not always move gradually. Sometimes they compress years of adjustment into weeks. Sometimes they demand speed from structures built for patience. And when that happens, long-term thinking does not fail slowly. It fails all at once. The tension began when short-term conditions shifted faster than long-term structures could respond. Not because fundamentals collapsed, but because timing did. Interest rates moved abruptly. Funding costs adjusted. Volatility returned after long absence. None of this was unprecedented. What was new was the speed. Long-term portfolios were not built to move quickly. Their strength was commitment. Capital was allocated with the expectation that it would remain deployed through cycles. Risk was measured over years, not days. Liquidity buffers were sized accordingly. As prices began to adjust, these investors did what they were designed to do. They held. They absorbed early losses. They trusted the horizon. In isolation, this behavior was stabilizing. But markets do not operate in isolation. Other participants needed liquidity now. Short-term traders repositioned rapidly. Leverage strategies reduced exposure. Risk limits tightened. Selling pressure increased, not from panic, but from mechanics. Normally, long-term capital would step in. This time, it was already fully committed. The market began to feel lopsided. Buyers were patient. Sellers were urgent. Prices adjusted downward to reconcile the mismatch. Each move tested the resolve of long-term holders. Losses were not catastrophic, but they accumulated quickly enough to matter. As stress spread, something unexpected happened. Long-term investors began facing short-term constraints. Margin requirements increased. Cash needs arose elsewhere. Rebalancing rules triggered. The very institutions built to ignore noise were forced to respond to it. This is where the contradiction sharpened. Long-term thinking had reduced optionality. Positions were large. Exits were slow. And now, time itself became a liability. Every day of adjustment increased pressure on structures that assumed gradual change. The market did not collapse. It compressed. Prices moved in steps instead of flows. Liquidity appeared briefly, then vanished. Volatility spiked not because of fear, but because adjustment had been delayed too long. Long-term discipline had smoothed risk for years. Now it was amplifying it, and the system was only halfway through the adjustment. The conflict deepened as the mismatch between horizon and reality became impossible to ignore. Long-term investors were no longer just absorbing volatility. They were becoming its source. Their inability to move quickly forced a market to do the adjusting for them. As prices continued to fall, pressure built inside portfolios designed for endurance, not speed. Losses triggered governance thresholds. Committees convened. Policies written for rare scenarios were suddenly activated. Decisions that once took months now had to be made in days. This was unfamiliar territory. Long-term capital was comfortable with uncertainty, but not with urgency. Yet urgency was now unavoidable. Cash was needed. Allocations had to be revisited. Assets once assumed permanent were reclassified as negotiable. When these institutions finally began to act, the impact was outsized. Positions were large. Liquidity was limited. Selling did not happen quietly. Each adjustment rippled through prices, signaling stress to the rest of the market. Short-term participants reacted immediately. Algorithms detected flow. Traders stepped back. Spreads widened. The same patience that once stabilized markets now created bottlenecks. Too much capital tried to move through exits designed for trickles. What made the moment destabilizing was its inevitability. No one had acted recklessly. No one had violated discipline. Long-term thinking had been applied exactly as intended, but the environment had changed faster than discipline could adapt. As volatility climbed, correlations tightened. Assets that were meant to diversify risk moved together. Hedging became less effective. The system began behaving as one large position instead of many independent ones. This is where chaos emerged. Not emotional chaos, but structural chaos. The orderly unwinding of long-term exposure collided with short-term market mechanics. Timing mismatches multiplied. Each forced sale made the next one harder. The market was no longer debating value. It was negotiating time, and time was in short supply. The buildup was complete. What began as patience had transformed into pressure, and pressure was now demanding release. The breaking point came when long-term discipline finally collided with short-term reality. The very investors meant to stabilize the system were forced to move, not because their beliefs had changed, but because their structures left no alternative. Once selling began in earnest, the adjustment accelerated. Markets did not wait for thoughtful repositioning. Prices moved ahead of decisions. Liquidity retreated further as participants anticipated flow. What had been a gradual repricing turned into a compressed release of years of accumulated pressure. In hindsight, the paradox became clear. Long-term thinking had succeeded too well. By absorbing volatility for so long, it allowed imbalances to grow unchecked. Risk did not disappear. It concentrated, and when conditions shifted, the release was sudden. Afterward, the lesson was not that patience is flawed. It was that patience must be paired with adaptability. Time horizons are not shields. They are assumptions, and when markets demand speed, structures built only for endurance can struggle. This story matters because it continues to repeat. Each cycle encourages longer horizons, deeper commitments, and greater confidence in stability. Each calm period convinces investors that time will smooth outcomes, until the market reminds them that time can also compress. Long-term thinking remains essential, but when it becomes rigid, it can turn from anchor to weight. The challenge is not choosing patience over reaction. It is knowing when patience quietly removes the ability to respond. So what do you think? Are today's long-term strategies building resilience, or are they quietly setting the stage for the next burst of short-term chaos? When long